Hello, everyone. Welcome to our new Silver Hill Funding webinar. So happy you could join us today. My name is Zach North. I work in marketing here at Silver Hill. I'm joined with Juan Barcelo, our head of sales. This is our second webinar since we've returned to market. We're really excited to talk to you today about a topic that we heard a lot about on the last call. I got a lot of questions from attendees saying, "Hey, where's your rate sheet? When do you have a new pricing matrix? How can I see where your rates are today?" So we thought, all right, the most important thing for us to do is to produce this sheet for you and then give you the opportunity to see it in detail and hear from us about each aspect of our new rate sheet. So I'm going to hand it off to Juan in a second. I just want to tell you that you can use the question pane to ask questions throughout the presentation, and I'll send as many of them as possible on to Juan. And also, I want to let you know that at any moment, you could always download the rate sheet and see it for yourself. For that, you can contact your Silver Hill regional manager, and we'll give you instructions on how to do that if you don't know already later on in this presentation. So with that said, Juan, please take it away.
All right, Zach, welcome back, and we're ready to do our second webinar. We're very excited that we were able to start originating again in October, and we've seen a healthy pipeline grow since then. So we're very excited, and we think there's a lot of demand for our product out there, and creating an avenue of revenue for our brokers is really exciting as well. So let's get started. Like Zach said, we're going to start looking at our rate sheet, and really what we're going to do is talk about what's changed. How's our product different? How is it the same? Looking at the rate sheet in detail, so that everybody can understand, our adjustments, given LTV, given credit scores, and like that, get a better understanding of where you can be as far as pricing your loans out. And finally, how to connect with us. We'll have a graphic up of the states with our team up there, and you can see what state you're in as a broker, and you can contact one of our AEs to start helping you out and start looking at deals. Okay, so it's definitely new day for us. We've come back, and while we have the same folks, the same team around, our product is very different. So what does that mean? What's new? We're focused on our commercial offering exclusively. We really want to drill down into those commercial property types. We are only doing full doc with a greater emphasis on debt service coverage ratio. We really want to understand how this year went for properties that are investment properties or businesses when it's an owner-occupied borrower. So we really focus on that cash flow for the year. We are working on more automation, fewer touches, new responsibilities. We have changed our appraisal process a little bit. Our deposits are different now. So we'll get into more of that as we go along. So what's still the same? Brokers are still protected. You guys are our main business. We are a wholesale lender, and we do all of our business through brokers. So we are going to definitely continue to protect who are our customers. So it provides you the same kind of protection that we did last time. Okay, we'll work with you exclusively, and you can work with your borrowers. Closing certainty. Our team works with you to clarify requirements and provide timely qualification. As you guys know, if you've worked with us already, we assign a processor to each file, and that processor will work with you through to closing. Okay. Team structure. As I mentioned, we have the same team. Same management teams come back. Some of our folks have moved on to helping one of our other divisions within our parent company, and so we have a smaller group that's back. So the idea is it's the same folks you've been working with for the last 4 years. We all came back, the core group, and while our team is smaller, it's the same folks that you've been dealing with historically. Okay. So we always like to talk about, like, okay, why Silver Hill? Like, why should I send you a deal? What is your place in the market? What space do you fill overall in the capital spectrum? So, look, we are an alternative lender. We offer alternative solutions to folks who have not had good luck at banks. Okay, so it's a deal that just outside of the bank's either lending footprint, underwriting guidelines, or what have you. You had a borrower, went to the bank, they couldn't do the deal for X, Y, or Z reason, and it's not because they have bad credit or they can't document. It's just because maybe the debt service coverage doesn't fit, or maybe the bank doesn't like their personal income situation. So a lot of different reasons why deals fall out of banks. We exist to kind of be there as a solution, as a backstop to the banks. Okay, SBA programs. Sure, SBA is a great deal, but I've talked to several bankers that we do business with and people in the industry, and the SBA really is focused right now on the PPP program, given the pandemic and everything that's happened. And they're really not doing a lot of SBA loans for real estate. There are some lenders that are doing them, and there are some banks that are doing them, but it's not the same focus as before. Those SBA program lenders are more focused on providing these relief programs and these emergency loans to customers. So, even if your borrower gets the attention of an SBA lender, they may not be able to work out. Okay, with SBA you have added fees, you have 2 closings usually. Yes, they give you more leverage, but it's a completely different and more complex process. So those loans are good loans that we want to take a look at and take a stab at. Okay, borrowers with maturing loans, we end up doing, and these 2 bullet points, maturing loans and borrowers wishing to refinance at a higher rates because they have a short-term bridge loan. We get a lot of that, where folks did an acquisition bridge transaction to get into the property, or they may have even bought a property cash and now they want to recapitalize, or if they finance under a bridge, they want to get out of that 10%, 12% rate and into a longer, more stabilized loan product that's long term, that's 5 years or even our 30-year fixed. So these 2 here in the middle, these 2 checkpoints or bullet points, they are what we see the most of. Okay, my loan is maturing with a bank or with a lender, and I need to refi, or I want to get out of a higher rate bridge loan. Okay, we used to do reduced doc, no doc, and you can see that scratched out because that's no longer part of our product. Okay, we're only doing full doc these days. And finally, cash out. Folks that want to cash out equity, instead of going to some of these, fintechs where they do the merchant cash advance and all these different crazy loans that they have out there. Yeah, you can get the loan in 2 days, but you're paying 25% interest. Okay, and they're usually 3, 6, and 9 month loans, maybe even 12 months, with very high interest rates, and they pull that money directly out of your business account. So some borrowers, if they need $50,000 for working capital or for investing in another property or for whatever reason, they'd rather not do that. And if they have equity in their commercial property, then we're a good option for them to cash out some money. Okay, we do a lot of loans, believe it or not. We do see a lot of loans where people have no mortgage on their property and they want to take out cash to go either buy another property. Most of the time it's to buy another property, but many other times it's for different reasons. They're funding projects, they need working capital, and so getting a rate in the 6s versus getting a quick loan, paying 25% interest rate is a big difference to cash flow. So that's another one. So I would say borrowers with maturing loans, wanting to get out of high interest rates or bridge loans and wanting to cash out money is our sweet spot. Okay, and that's when it makes sense to go to Silver Hill. So who are these people? Well, they're real estate investors. They they're not willing to do a global cash flow on a multifamily property. They don't want to involve their personal income. Not necessarily about documentation, but it's more about how to underwrite. We're just going to look at the property's cash flow. So we're just interested in what the property is doing, not necessarily what that borrower's personal situation is. Okay. Folks that value speed and doc flexibility, for our investment property, we're going to do a very different underwrite than the banks would. Our owner-occupied stuff, which is your small business owners, we're going to do it very similar to a bank as far as underwriting, although we're a little bit more flexible than what a bank would do. But for the most part, real estate investors looking to cash out, looking for speed, and unwilling to meet the bank requirements are good fits for us. And then you have your small business owners, okay? And we talked a little bit about it. Cash out for working capital, for inventory, for payroll, okay? Those are sweet spots for us. Maybe they've had some issues with their business historically, and banks usually want you to be, 3 years in business and stable. Okay, we don't have that requirement. Okay, we'll take a look at your business if it's, 24 months old, not a problem for us. So real estate investors and small business owners are the kind of borrowers that we're looking at. So let's look at the pricing matrix. Basically the idea is, and some of you may already have this and may have reviewed the pricing matrix. You may have been sent one by our reps. Okay, but today what we're going to do is really dive into this and look at detail how to really work with our pricing matrix, because this is what generates our pricing. This is how we structure loans. This is our program, really. Okay, so program overview, we're going to look at tier 1 property types, and I'll explain what that is. We're going to look at tier 2s, our pricing adjustments, our debt service coverage requirements, our fees to close loans, and finally broker compensation, which is the most important. So the focus is today really, and since we've come back, our focus is commercial real estate property. Okay, so we're going to offer purchase, cash out, or refinance. As I mentioned, probably 50% of our loans are cash outs, and then we do a mix of rate and term refi and purchases for the other 50%. We do loans between $100,000 and $2 million. Our sweet spot really is under $1 million. That's where we really are most competitive and where the product works best. We offer amortizations of 15, 25, and 30. Most of our borrowers go with 30 years. As far as max LTV, this is one change that we have made. We will go 75% max on loans under 500,000 and 70% on loans over 500,000. So 500,000 to 2 million, 70% is the cap. We used to go to 80%, but we've changed now, having come back after the whole closure earlier on this year. Minimum FICOs, we can do a loan for as low as 650 middle credit score, okay? So we can do it, but the pricing is not going to be very attractive. So we really want to see loans above 700. That's where our pricing is going to be best and most competitive. So doesn't mean we won't do 675 or 650. It's just that our pricing is going to be a lot better the higher you go. Okay. As far as minimum debt service to do a loan, 1.2 for owner occupied, 1.15 for investor. Those do have some conditions. Obviously, the lower the debt service coverage, the higher we're going to require the credit score to be. So these minimums are there for the highest of credit scores, usually over 750. Stabilization requirement is the same. We haven't changed that. We need a property that's 75% occupied, and it's been occupied that way for at least 90 days. As far as owner-occupied loans, how we underwrite them, it's a global debt service with a real strong focus on the business. when people do global cash flows at banks, they really look at the whole picture. We will look at the whole picture, but we're going to focus more on that business. If that business is doing well, then, unless the personal income side or the personal expense side of that borrower is disastrous, we can move forward with a loan. Whereas in a bank, when they do global, they want to see the full picture and they're going to consider both. Okay. For investor deals, which is about 70% of what we do, we're going to look only at the property. All right. Property cash flows is the name of the game, and we're going to look to those debt service coverage ratios to make sure that they work. As far as prepayment fees, we have 3 different options. 5% for 5 years, which is our most popular because it's the lowest rate. You get a rate reduction for that 5% for 5 years, or you can go 5% for 3 years, and then some folks go with a decline. My suggestion always on prepayment fees is that, look, with our program, we have a 5-year ARM and a 30-year fixed. If you're going to do either and stay in the property for that 5 years, as a borrower, you may as well take the longest prepayment fee period because it's going to get you a lower rate. As far as documentation, we will collect 2 years personal and business tax returns, but I want to go back to our underwriting. We are going to still focus on, for investor, the property itself, and for owner-occupied, the business. We do collect personal tax returns and business tax returns. They don't factor as much into our underwriting as they do at a bank. So we do this for documentation purposes. Granted, most importantly is going to be on an owner-occupied deal, getting those personal and business returns. But on an investor deal, very different, And what we really want to see this year is year-to-date financials. Year-to-date on the property, year-to-date on the business. Because we want to see how they dealt with that whole period in the spring when the pandemic first started and how they've been able to, adjust and bounce back. This is our grid. Okay, so let's talk about Tier 1. So Tier 1 is your traditional multifamily apartment building, 5+ units. Anything less than 5 units is not considered commercial. Okay, so multifamily is Tier 1, and mixed use is also Tier 1. Mixed use with primary residential income is what that means. Okay, this Tier 1 makes up about 45% of our business. Okay, and it's what we do most of. They're the easiest to underwrite, and we have the most success with them. And as you can see, we have tiers, credit score to LTV. Okay, obviously, low, high credit score, low LTV, you're going to have the best rates. Okay, low credit score, high LTV, you're going to have the worst rates. All right, but typically our average rate is probably around 6.5, and that's including yield spread. Okay, we are writing some loans, in the high 5 for those higher credit scores. And as I mentioned, we do a lot of loans at 50-55% LTV because folks either have a low payoff or don't have a mortgage at all. So this gives you an opportunity to see how our Tier 1 is priced. Okay, so these are base rates, assuming like a 5-year ARM, 30-year AM. These rates, as you can see, are different. They are Tier 2. So Tier 2 is everything else commercial. Your retail, any single unit retail, small strip centers, larger strip centers, mixed use, which with primarily commercial income. Okay, warehouse, self-storage, office, light industrial, automotive, and mobile home parks. Okay, 2 properties that we're not doing this time around under Tier 2 is restaurant, bars, and daycares, as you would expect, because of the current pandemic and municipal restrictions around these properties. We've decided to suspend lending on them now coming back. Okay, but we do still see a fair amount of mixed use, automotive, warehouse, self-storage, office, and light industrial. Okay, and again, see how the FICO bands, are reflect the LTVs and what rate they get. Okay, again, lower LTV, higher FICO, you're going to get the better rates. Okay, higher FICO, higher LTV, your rates get worse. Okay, so our sweet spot's like somewhere in the middle. Okay, somewhere in the middle. So our adjustment. So when figuring out our pricing, you basically have to look at this grid, the base rate, and then add or subtract adjustments. So we have all of our improvements on the left and our worsening adjustments on the right. So for loans over 500,000, you're going to improve this base rate by 50 basis points. Okay, 15-year, 3/8 better. 25-year, an 8 better. We talked about the prepayment fees. They adjust the rate down by a quarter, and the declining adjusts the 5-year 5% adjusts by a quarter, and the declining 5-year adjusts down by an 8. Conversely, these are adjustments that worsen the rate. So loans under 250,000 worsen the rate. So you would look at this rate and add the adjustment. Okay, tier 2 properties. Okay, right now we're not doing 1-4s, although it's part of our mix. We are not originating those at this moment. More to come on that in future webinars. 30-year fixed, 25 basis points, and finally automotive properties, 25 basis points. This is where we adjust for risk. And this is the improvements is that we want to see more of this stuff. Okay, that's why we make the rate better. Caps and floors, these are arms for the 5-year. So you have your periodic caps at 2, 6, and 1. Okay, or I'm sorry, 2, 1, and 6. The 6% is the life cap on the loan. So we can never go higher than 6% plus the starting rate. A lot of our borrowers are actually going with the fixed for 30-year deal. They like the fact that they can get a rate in the 6s and lock it in for the length of the loan. Okay, but we do offer the 5-1 arm, and that's where these periodic caps come in. So we have developed something new, which is a DSCR FICO correlation. Okay, I'm not going to go too much into detail with this because this has a lot to do with your expenses on the property that you submit. Sometimes we look at expenses differently than owners do because we account for more things like management fees and replacement reserves, where maybe some borrowers may not include that. So I wouldn't get too bogged down with, what the requirements are. Just you need to understand that our minimums are 1.2 and 1.15. 1.2 owner occupied, 1.15 investor, and that has to do with the FICO scores. Okay, so this is something that's new. This is us adjusting for risk in the market related to cash flow as a result of the pandemic. So we didn't do this before. Now we're doing it going forward, and then we can adjust these as we go along, as the economy improves, as the situation changes with jobs and unemployment, and hopefully we get these vaccines to come out soon, and this pandemic starts to go away. We will adjust these as well. So I wouldn't worry too much about these, other than reach out if you have a deal with one of our reps to discuss. So our fees, we did talk about our fees. So one thing that's different is we are no longer collecting a $500 deposit. Okay, before what we did was we took a $500 deposit to start the loan, and then we would pay for the appraisal and take that risk. Now we've changed a little bit. Okay, What we've done now is we're not going to collect the $500, but we are going to require that the borrower pays for the appraisal up front. Okay? So once that payment is made, it basically starts the processing of the loan. You know, we have a system where, like residential, if any of you are familiar with how residential does it, we have an ANC, they'll send a payment link to the borrower pays them directly. Okay? We get the order going and we go from there. Now, one thing that is different as far as our fees is our underwriting fee. It used to be $2,000. Now it's 1% of the loan. Okay? You know, some people might think, well, 1%, that's a lot. Really, you know, when we look at what we were doing in the past 3 years, we were charging $2,000. Our average loan size was about $400,000, $500,000. So it ended up being about 50 basis points or half a point. Now we moved it up to a point. You know, and again, this is adjusting for risk and defaults related to everything that's been going on. And these things could change down the road. Our legal doc prep fee is the same. We do have to pay attorneys to review the closing documents, and so that's part of that fee. As far as broker comp, you know, this is one area where we did have to make changes. Obviously, I wasn't so happy about it because I want our customers to, you know, maximize their opportunity with us. But this ended up being in line with what we saw in the last 3 years, which is most brokers end up making between 2 and 3 points on a loan. So what we did is we matched what was happening for the last 3 years to our guidelines. So before, our origination max capped out at 3 points, we lowered it to 2, and our yield spread capped out at 2 points, and we also lowered that to 1. Okay, so you can still make 3 points on loans. But what we saw historically in the last 3 years is most brokers only made 2 to 3, most of them making 2. You know, some of them making 3 points. But when you're talking about, you know, borrowers that we're looking for, which is your higher FICO borrower that wants a lower rate, you know, they're not always going to pay a lot of points. You know, the folks that pay a lot of points are folks that have very little options left in the market, and they're forced to pay, you know, whatever they have to get financing. So the kind of borrowers that we're seeing, you know, have higher credit scores and won't have the tolerance to pay those high points for these rates in this program. Okay? So, you know, if you want to get your rate sheet, you got to contact one of our guys. They'll talk to you, and gals. They'll talk to you about, you know, our product. They'll go into detail. They'll provide you with our rate sheet. This is what it looks like. You know, we go based on where our customers, our brokers are located. So not necessarily where the property is, but where the broker is. So if you're in one of these regions, you can reach out to these folks directly. You may already be in touch with them. You know, here's a map of the states and our folks on there. If you go to our website, silverhillfunding.com, and you go to contact, you'll see this map, and you'll see our email addresses for everybody and phone numbers as well. I want you to pay close attention to the bottom here because it shows the states where we do not do business. And we actually added Delaware, who used to be on this list, but we took them off the list because now we can lend in Delaware. Okay? And I think Tennessee, properties in Tennessee soon will be eligible as well. Okay? So again, you know, if you want to talk more in detail about our program, want to understand what our debt service requirements look like, how we look at deals, how we underwrite expenses, just reach out to one of our reps wherever you're located. So if you have a deal, which, Zach, most of the time, you know, folks that attend our webinars, they have deals, you know, and they want to basically ask questions about it. Just reach out to us. You can reach out to me as well, and I'll get you in touch with one of my sales reps. So, you know, feel free, again, to reach out via email. Email is probably the best way to contact me, and then I'll get you going with one of our reps. So Zach, I mean, today's was short and sweet, and really to the point, talking about our rate sheet and what we're looking at and what our sweet spots are. So, if we have any questions, I think we have some time.
Hey, Juan. Thank you. That was a great presentation. I think everyone really appreciated it here. We have a few questions. Kind of like I said last time, really nice to see some familiar names here. We definitely missed everyone. So I have one or two I can answer myself, actually. A question about what the different colors on that map means. I know it kind of looks like there's a heat wave, but really that's just showing how we differentiate between regions. So you can look at that and kind of just tell, okay, well, I don't have a relationship with someone at Silver Hill in the West Coast. You have the options there. And so you can kind of tell the difference of how we break apart the country. So that's what that means. I also have one I can answer here about the pricing adjustment for tier 2, why that was shown as a pricing adjustment when there's also a matrix. And that is because on our documentation, we don't always show both. We don't always have space to show both of our matrices. So we sometimes save time by showing it as an adjustment. So it's not double counting. That's what that means. We're just trying to provide as much information as possible. So with that said, Juan, I have some questions here. One was about just if you could provide a little more information about full doc, because if we're not offering the no doc, light doc programs, what kind of documentation are we looking to get on a commercial loan? And I know that depends on the type of loan, but can you add a little more color about what we're looking at from a documentation perspective?
Sure. I mean, what we're gonna look for is we're gonna look for, especially this year, we really want to see year to date. So we want to see year to date financials. If it's an owner-occupied deal, we want to see year to date financials for that business. What does the P&L look like? And then we're going to want to see 2 years of tax returns for the business to compare trends, right? If this year looks like the last 2 years, okay? As far as the personal tax returns, we're going to require that on everything, but it's for documentation purposes. We're really not going to delve into the personal income, especially on investor deals. Really what we're looking for is, trending, right? What does it look like from one year to the other and into this year? And how is this year different from other years? There's some businesses that have benefited from the pandemic, right? And so we want to see, like, the last 2 years, how much they benefited. Obviously, we're not going to count, a surge in income because this year they had a great year, but traditionally it's different. So we need to understand, what the trending is, and so that's the spirit behind the tax returns. As far as investor property, the one difference as far as documentation is concerned is going to be bank statements. We're going to want to see, for example, for an 8-unit multifamily, we're going to want to see that they've been able to collect rents. As everybody knows, there was an eviction moratorium around the country due to the pandemic, but that doesn't mean people were collecting full rents. So, and some apartments we've seen have not been able to continue to collect full rents even after, March and April, and May, which was really the worst period of the economy. So we're going to want to see that as well during the underwriting process. So a lot of the documentation revolves around really understanding what's happened this year, how is it different from years past. So really, if anybody did our full doc program last time, it's the same full doc program. It's just that we're going to have more focus on year to date financials for 2020 than we did before.
Perfect, thanks. So I have a few more here. One, maybe a quicker one. One, are we offering blanket loans today?
Good question. That's one of the items that we changed. We used to do blanket loans on, the 1 to 4 unit residential investment property, but we're not doing those right now. More to come on that, but the answer to that question is no.
Okay, thank you. So some questions about DSCR cash flow, especially with everything that's been going on in this country. I think Juan, you touched on that. Is there anything more you'd like to add about the DSCR for us today, and how we're looking at cash flow? Anything that might help the brokers as they're sending us deals?
I just want to reiterate that our debt service requirements are this time around are tied to credit score. So the higher the credit, the lower the debt service. But for that kind of stuff, every deal really is different, and I would suggest just reaching out to our rep so that you can look at expenses and all that stuff.
All right, great. Well, it looks like we have one here. So someone here is talking about year-to-date financials, where they can access a term sheet. So I guess as they're sort of putting the deal together, do you recommend that brokers here reach out to the regional manager for more information specifically on how to structure the deal when they submit it?
Absolutely, and we have rent roll forms. We have year-to-date operating statement forms that can be filled out. So those are on our website, but I would suggest talking to our rep so they can kind of guide you to how we're going to structure the loan.
Perfect. Well, everyone, I see some more questions here, kind of some more specific ones about types of deals, specific deals. I think we've got team members here who would love to talk to you about that, and we'll try to connect you as fast as we can. I want to let everyone know that I'm going to be sending you a recording of this presentation tomorrow. So this to me, this is a great one to refer back to you over time. You'll have the rate sheet in front of you, but maybe there's more information. I mean, that's what I'm going to do personally. I'm going to keep a tab on this one because I think there's a lot of helpful information, and that might save some time as you're starting to look at deals to send to Silver Hill. So, Juan, thank you so much for taking the time. Everyone, thanks for joining us. I think we're happy to give you back a little bit of the hour here. So thank you so much, Juan. I'll let you close it out for us.
All right, Zach, thanks a lot. And again, folks, we're happy to be back and glad that you're back with us. And we're looking forward to seeing some of your deals and continuing to educate you as we move forward. Given this crazy year. So thanks again for spending some time with us, and we look forward to doing business with you. Take care.